He bought his very first stock at 11 years old. Decades later, people would call him one of the greatest investors who ever lived. But here's the strange part. His method was never complicated. He never used secret formulas. He never chased the hottest new trend of the moment. In fact, most of his biggest wins came from simply refusing to do what everyone else was doing. So how does someone build one of the largest fortunes in modern history, using ideas simple enough to explain in a few sentences? Welcome to Capital Story, where we break down the world of finance, from the biggest crashes in history to the ideas and people that shaped how money works today. In this video, we're looking at Warren Buffett, not just what he did, but the actual thinking behind how he did it. Let's start at the beginning. Warren Buffett grew up in Omaha, Nebraska, the son of a stockbroker and congressman. From a very young age, he wasn't just interested in money. He was obsessed with the mechanics of how money grew. As a kid, he sold chewing gum and soda door to door. He delivered newspapers. He even co-owned pinball machines placed in local barbershops, collecting coins from them every week like a tiny business empire. By age 11, he'd saved enough to buy his first shares of stock. It didn't make him rich. In fact, it taught him an early lesson about patience. He sold too early, watched the stock keep climbing afterward, and never forgot how that felt. By the time he was a teenager, he'd already filed his first tax return and had saved several $1,000s from his various ventures, an enormous sum for a kid in that era. Here's the thing to notice already. Buffett wasn't obsessed with a lucky break. He was obsessed with the process, how money moves, how it grows, how small decisions compound over time. That word, compound, turns out to be at the very center of everything he'd go on to build. After studying economics, Buffett found his way to Columbia Business School, where he studied under a professor named Benjamin Graham. This single relationship changed the direction of his entire life. Graham had developed an approach to investing that was almost the opposite of how most people thought about the stock market. Instead of trying to guess which company would be exciting or trendy in the future, Graham's method was about figuring out what a company was actually worth, its real underlying value, and then only buying it if the stock price was sitting well below that value. This approach became known as value investing. The logic is almost stubbornly simple. Imagine finding a $1 bill on the ground, but somehow it's being sold for 60 cents. You don't need to predict the future to know that's a good deal. You just need to recognize the gap between price and value. Buffett took this idea and spent the rest of his career refining it into an art form. After working directly for Graham for a few years, Buffett eventually returned to Omaha and started managing money for a small group of family and friends through investment partnerships. His early returns were remarkable, consistently beating the broader stock market year after year using this same value-focused approach. By 1965, Buffett had taken control of a struggling textile manufacturing company called Berkshire Hathaway. Here's an important detail most people don't know. The textile business itself was actually a bad investment. It was a declining industry, and Buffett would later admit that buying it in the first place was one of his early mistakes. But what he did next changed everything. Instead of trying to save a dying textile company, Buffett used it as a shell, a financial vehicle, to start buying stakes in other, much stronger businesses. Insurance companies, consumer brands, manufacturing firms. Berkshire Hathaway slowly transformed from a failing textile mill into one of the largest holding companies in the world. So what exactly was Buffett looking for when he bought into a company? This is where his philosophy really takes shape, and it comes down to a few consistent principles. The first is what he often referred to as a company's moat. Picture a medieval castle surrounded by a deep moat of water, making it difficult for enemies to get close. Buffett looked for businesses with the same kind of protection, but instead of water, The moat is something like a powerful brand, a loyal customer base, a cost advantage competitors can't easily copy, or a product people simply can't replace with something cheaper. A company with a strong moat can keep competitors out for decades, protecting its profits over the long run. A company without one is constantly vulnerable, no matter how well it's doing right now. The second principle is understanding the business itself, deeply and simply. Buffett became famous for avoiding companies whose business models he couldn't easily explain in plain language. During the dot-com boom of the late 1990s, when nearly every investor on the planet was rushing into fast-growing internet companies, Buffett largely stayed out. Critics at the time accused him of being outdated, of not understanding the future. Then the dot-com bubble collapsed, wiping out enormous amounts of wealth almost overnight. Buffett hadn't predicted the crash specifically. He simply hadn't invested in businesses he couldn't confidently understand and value in the first place, so there was nothing to lose when the bubble burst. But there's an interesting piece of psychology in all of this. Most people, when they invest, actually forget they're buying a piece of a real company. They see green and red numbers on a screen. They see charts. They see headlines. And then they base every decision on exactly that. Buffett looked at it in a completely different way. He would ask himself a simple question. If the stock market shut down tomorrow for the next 10 years, would I still be happy owning a piece of this business? It sounds strange the first time you hear it, because most people today, when they invest, are thinking about tomorrow, next week, or at most next month. But what Buffett was actually looking at was whether a company would still be making money 10 years from now. Think about it this way. Say you buy a small coffee shop in your neighborhood. The next day, someone tells you, your shop's value dropped 8% today. You're probably not going to go sell it, because you know people are still buying coffee. The business is still running. Customers are still walking in. Nothing in real life actually changed. But the moment that exact same business starts trading on the stock market, things change. The price drops 8%, and suddenly people start selling out of panic. This is exactly what Buffett spent years trying to explain. Price and value are not the same thing. The market sometimes makes a company look far more expensive than it actually is. And sometimes it does the opposite. While people are selling out of fear, it hands you the chance to buy genuinely valuable companies at incredibly cheap prices. Buffett took advantage of this exact psychology over and over throughout his entire career, because instead of following the market, he was following people. He wasn't trying to figure out when people were being rational. He was trying to figure out when they were acting purely on emotion. When greed was rising, he slowed down. When fear reached its peak, he moved. From the outside, that sounds easy. But honestly, doing this when real money is on the line is incredibly difficult. Because it means buying while everyone else is selling. And it means doing absolutely nothing while everyone else is buying. What actually separated Buffett from most other investors wasn't that he was smarter. It was that he could control his own emotions. And that might be the hardest part of investing, period. Something even harder than analyzing a company is managing your own psychology. That same emotional control led to a second, closely related trait: real, extreme, almost uncomfortable patience. Buffett has held on to some of his core investments for decades, refusing to sell even when short-term market conditions looked shaky. His reasoning is straightforward. If you've correctly identified a genuinely strong business, temporary price swings in the stock market don't actually change what that business is worth underneath. Panic selling during a downturn, in his view, usually has far more to do with emotion than with facts. This patience connects to perhaps his most repeated piece of advice: be fearful when others are greedy, and be greedy when others are fearful. In practice, this means Buffett has historically done some of his biggest buying during moments of market panic, the 2008 financial crisis being one of the clearest examples. While many investors were selling in fear, Buffett was pouring billions of dollars into companies at prices that later turned out to be extraordinary bargains. There's a fourth, quieter principle that doesn't get talked about as much: living far below his means. Despite becoming one of the wealthiest people on the planet, Buffett has lived in the same modest house in Omaha that he purchased back in 1958. He's spoken often about avoiding unnecessary luxury, not because he can't afford it, but because he simply never saw the appeal in it. To him, money was never really about the spending. It was about the freedom and independence it created. This might be one of the most overlooked parts of his philosophy. Buffett didn't just build wealth by picking good investments. He built it by refusing to let his lifestyle expand along with his fortune, which meant more capital stayed invested, compounding year after year, instead of being spent. And that word again, compounding, is really the engine behind almost everything Buffett achieved. The vast majority of Buffett's fortune wasn't built in his 20s, 30s, or even his 40s. The overwhelming majority of his wealth was created after he turned 50, and an enormous portion of it came after he turned 60. Not because his strategy suddenly changed, but because compounding needs time to show its real power. Small, consistent growth, left alone for decades, eventually produces numbers that look almost unbelievable. This is perhaps the least exciting and most important lesson in his entire story. There was no single genius trade that made Buffett one of the richest people alive. There was a simple approach, applied with discipline, repeated patiently, for well over half a century. Today, Berkshire Hathaway owns significant stakes in some of the most recognizable companies in the world, spanning insurance, railroads, energy, consumer goods, and technology. Buffett himself has pledged to give away the overwhelming majority of his fortune to charitable causes rather than pass it entirely to his own family, a decision that, in its own way, reflects the same philosophy he applied to investing: think long-term and think beyond yourself. So what's the actual takeaway from all of this? It's tempting to look at Buffett's story and search for some hidden trick, some secret formula only he figured out. But maybe the more uncomfortable truth is that there wasn't one. Understand what you're buying. Look for real, lasting value. Be patient enough to let time do the work most people are too impatient to wait for. None of that is complicated. It's just difficult to actually stick with for 50 or 60 years, while the rest of the world keeps chasing whatever looks exciting this week. If you found this useful, make sure to subscribe. Every week, we cover a new piece of the financial world, from history to strategy to the people behind it.